Hello everyone and welcome to another exciting week of economics and financial markets here at ACY Securities. I'm Clifford Bennett, Chief Economist, and it's very happy to have you on board. Unfortunately, some of the news is not so sweet, and that is that in the Ukraine situation, of course, there is ongoing deterioration in that situation and outlook, and I would even place the probability of a Russian invasion now as high as 85%. We've seen, President Biden on the air over the weekend saying it's 100%, but let's maintain a little bit of hope here that it's an 85% probability, but that's terrible, isn't it? There's a lot of reasons why why Russia is pressuring Ukraine and the West to back down on the idea of Ukraine joining NATO. I did write a written piece on that on Friday. If you haven't seen that, please go to our website, acy.com, or email me directly, clifford.bennett@acy.com, and I will get a copy of that to you, because it is important to understand the Russian perspective on all this and not just the Western perspective, because what we're trying to figure out is if conflict will actually happen, and to do so you have to analyze both points of view and not just one. And when you do that, you can see that yes, it is likely, probable perhaps, that without some sort of assurance that Ukraine will not be joining NATO, and I'm not saying you agree or disagree, I'm just saying working through the perspective of both sides, without such an assurance, a conflict does appear likely. Now, what a lot of people aren't recognizing is what comes after that first conflict outbreak, and that will be an ongoing concern, risk, nervousness about the possibility of the conflict spreading in some way along Russian NATO borders. So you will see hyper-military activity and tension all along that border, and that will of course come just after Russia has acted on the Ukraine. And now the number one and first way Russia will attack Ukraine, we see all these images of tanks, but it is in the area of air superiority that Russia really has full advantage. There's really nothing Ukraine can do about the Russian Air Force. So Russia certainly has all-out air superiority in this situation, and of course their aircraft will be used, I believe, and I've heard, I used this description about a week ago, and I did start to hear it more in the media over the weekend, that Russia most probably would conduct a shock and awe approach to their invasion of Ukraine. We know that they've had partial evacuation along a 400-kilometer front of separatist areas back towards into safer areas of Russia, suggesting that there could well be a conflict zone developing. So yes, tanks would be rolling in, but watch for immediate attacks on all Ukrainian military establishments located throughout Ukraine, particularly anywhere near that sort of half of Ukraine close to the Russian border. And we could see immediate airstrikes on Kiev at significant military installations. This is something that would shock the markets. The markets are really thinking in terms of tanks rolling in, taking a 10-kilometer slice of Ukraine or something. It could be very different to that. It could be more akin to the United States shock and awe on Iraq, and that's what we have to prepare ourselves for. That's what I think there is an 85% probability of, and that is an entirely tragic situation, and it means real war, not a conflict, a real war, and that will be very damaging to markets. I think you could see markets collapse rather significantly. If we look at the Euro-US dollar chart, for instance, we can see that the market has been heavy for some time, and I guess if I was going to give you one word for this show today, and I'll probably put it in the title of the show, it is free fall. Think free fall. That is what we are facing if Russia conducts a shock and awe invasion of Ukraine. Absolutely market free fall. That will be in the Euro-US dollar, and I think it can move to 107, 105, even parity to the US dollar should such a conflict eventuate. Now, when it comes to the Australian dollar, a lot of people have sort of seen the Australian dollar as a potential safe haven currency down the bottom of the world, away from everything. And I think there's some validity to that argument from a military point of view, but I don't think there's much validity to that argument from an economic point of view. So I would see that as a kind of sentiment, flavor of sentiment in the market for a short term only, short period of time only, before the Australian dollar would begin to follow the euro south, as well as we see not only euro selling, but safe haven flows lifting the US dollar. And of course, those safe haven flows will continue to lift gold as well. If we move along to the US stock market, we can see that Friday was interesting because there was a little bit of a rally. At first, people were saying, oh, there's going to be a meet between the Secretary of State of the United States and the Foreign Minister of Russia, Lavrov, I think planned for Tuesday and still planned for, but it's becoming a little bit suspicious whether that meeting will actually go ahead. But that lifted the market a little bit on Friday. Yet as we went into Friday night trading, the New York session, it became apparent that things were beginning to move along the Russian-Ukraine front. And in fact, over the weekend, an exercise of 30,000 Russian and Belarus troops along near the Ukrainian border has been extended for 2 days, so that those troops remain active, conducting exercises very close to the Ukrainian border there, and again highlighting the fact that this would be an invasion not just from Russia but from Belarus as well. So the situation is very difficult for the Ukraine. So US stock markets on Friday did begin to price in the fact that there were increased numbers of shelling, and I think some troops have actually lost their lives over the weekend in some sporadic fire. So the situation does continue to deteriorate. A minister in the Ukrainian government had to seek shelter during one period of shelling as he tried to tour the front lines. So it is all unraveling there. And we all know that Russia is playing a game as well, perhaps of misdirect, but that's not the point. The point is, are they going to invade or not? And it's looking increasingly likely. And also Ukraine was probably doing a little bit of window dressing as well, even though, of course, we do hope that they remain intact as a nation. So that was what was happening in US equities on Friday, the beginning of the pricing in of, there's actually going to be a war. Just the mere beginning of that pricing in. Again, key word to keep in mind is think free fall. Free fall is the key word. That is the dominant risk in financial markets at the moment. When we come to Australian stocks, they've had a real attempt to rally over recent weeks, had a good run, but again, it looks exhausted. And to be honest, from a purely price action point of view, the AUS 200 looks to be on the edge of the abyss. No one else is saying that. Pretty much everyone in the market out there, and from where I am, I can look across Australia and the city and the Harbour Bridge and everything, and I'm thinking of all those other banks and brokers out there. Everyone's seeing this as a buy the dip situation, and they are really, there is a lot of bullish sentiment for the Australian market, with the idea that war could actually be good for our miners and things. And I don't know, I think if there's a broad market markdown, even if you have individual good stories, they could begin to get into trouble. And it made me think a little bit of, in other major dislocations throughout history, what has happened. And one has to only go back to the GFC to have a look at that kind of example of price action there. And one of the scenes in The Big Short, which if you watched all my previous videos from years ago, I occasionally had playing in the background as I spoke about markets, hint, hint. But one of the situations there was they were talking about the AAAs in terms of the mortgage bond products. And one of the things they said, if you're a big fan of the movie, it's the scene where they're at the conference and in the evening they're having a little chat, the two younger fund managers are having a bit of a chat. And they say, the three people at the table, sorry, I'm giving too much detail for this, but anyway, I'm trying to picture it and remember their names and I can't. But basically what they said was, you know what no one's thought of? Well, what do we need? What do we need? We need a trade. We need a new idea. What's no one thought of? No one has thought of selling the AAAs, right? Because they were considered the most secure bonds and no one had shorted them, okay? So that got me thinking, and so I'm thinking Apple here on your chart. Apple could be, no one's thought of selling Apple. Everyone in the world thinks you can safely buy Apple. that means the world is long Apple and leveraged so. If there were to be an unfortunate conflict or any other further catalyst to the downside, remember the US economy is weakening at the moment. China's economy is weakening at the moment, and Europe is hitting some serious headwinds as well, and I don't mean to pun about the weather over the weekend. So there are reasons to be doubtful about high valuations in stocks anyway. And if you think it's an idea, like sort of one of the obvious stocks to sell to me is a company like Uber or maybe Coinbase, because maybe the crypto tulip bulb period is entirely ending. But coming back to this idea of sell the AAAs, it's Apple, sell Apple. Well, I'm thinking of shorting Apple already, and also Tesla, by the way. But anyway, on Apple, I think if you go short here and we break this support level, there's a chance of that free fall being very evident in the number one stock in the world, Apple, which everyone is most confident about. Remember, markets have their biggest moves when they are most wrong, and people are heavily invested in Apple. If that's a story that begins to unravel, not that the company is going to go into any problems, not that they're going to do anything wrong in their product lineup, simply that the overvaluations of stocks generally around the world begins to be unwound with Ukraine acting as a catalyst for this process, then Apple could be a stock that also experiences, yes, you've got it, free fall. So a very happy, cheerful outlook on markets from me today. I haven't put up the chart of gold today. I've been putting it up every day saying buy gold, and you just continue to do so. So that's the one shiny aspect of things that are happening at the moment. But otherwise, I do think it's a perilous situation regarding Ukraine, and we need to be on our toes for that. And that has to be foremost in our thinking of how we approach our investment portfolio over the coming week. So that's Apple, yet another potential for free fall, even though it is Apple. Now, in data, we did get some economic data out in Australia today, which shows another upswing in the previous month in terms of economic activity. Services index displayed there, or here, sorry, from market. But it is a small survey, and it doesn't have the history that the official data series do. So you always have to take these releases with a grain of salt. But nevertheless, it shows the turbulence post-COVID recovery, the turbulence of the Australian economy. And that turbulence, remember I used to speak of how we're creating a roller coaster future by overstimulating, and in response to what would have been a normal recovery anyway from the slowdown to the COVID situation. So that roller coaster is ongoing. It's great that the most recent number is positive, and it's probably reasonably accurate that the Australian economy is picking up pace. But this has been my point all along, that yes, we would have a recovery, but we will not settle at the previous rate of growth. And you have to remember, before COVID happened, Australia only had 2% area GDP anyway. It was already below trend economy. It's not like we had this super duper economy before COVID hit. So I'm thinking really, and it's been my forecast the whole way through, that despite some good data showing some recovery post all of the lockdowns and things that we've had, and nice to see international travel increasing, but again, it's not going to be at a level that was similar to before. And in fact, Australia's travel industry came out today and said it will take years for the Australian travel industry to recover through international travel to what it was previously. So great to see good data, but just be wary and cautious because it has nothing to do with the medium to long-term outlook for the economy. What we're going to see is below trend, below potential sub-trend economic growth going forward, but with the huge problem of massive inflation and a Reserve Bank that fell asleep at the wheel a long time ago. Now, some people, as I said, some people are looking to the Australian dollar as a kind of safe haven trade, perhaps, on the Ukraine situation, which I'm not endorsing at all, but that is what a lot of people in the market are talking about. And that, of course, and one part of the thinking of all of that is that war might be good for metal prices. And we have just seen nickel hit a 10.5-year high. And that's just indicative of what's happening in a variety of metal prices. And there is definitely a valid argument about war creates greater industry, but we're not talking about here. I don't think a war that's going to become a world war or even a major European war across Europe or anything like that. And so therefore, probably all the military equipment that's required is already built. So I think the market could be a little bit askew on this idea and concept. And I don't like to really think about how to make money out of a war anyway, just protect yourself from a war. But these high prices in metals will probably continue for a short-term period of time, but I do not see them as being sustained. And I think probably commodity prices are overvalued at this point, but we're certainly going through some sort of commodity super cycle, nearing the end of that, and there is still some froth to be seen in commodity prices generally. But it could be a positive, certainly in the short term, at least short to medium term, for some Australian mining stocks. So the Australian market is caught here with an overall US weakening, global equity weakening of equities likely if Ukraine deteriorates, but perhaps some mining companies being standout examples of moving the other way. But I tend to think the overall sentiment shift to the downside could be so powerful that it even overwhelms that outlook. So again, I come back to the one shiny metal that really could be valuable to you, and that remains gold. My forecast since last year has been that gold will reach $2,500 US this year, with risk to $3,500 later this year or in 2023, and I stand by that forecast. Thank you very much. Clifford Bennett, Chief Economist, ACY Securities. Thanks very much for being with us.